If you want to find the absolutely cheapest money in America right now, you really don't look at average savings accounts.
No, definitely not.
Right, and you don't look at the checking accounts of everyday retail customers because, they're constantly shopping around for the latest promotional rate.
Chasing that extra 0.5%. Yeah.
Exactly. You actually have to look in the operating cash accounts of billionaires and ultra high net worth business owners.
Which is an entirely different world of banking.
It really is.
Yeah.
So today, we're looking at how one supposedly, boring regional bank figured this out, how they absorbed the elite talent from a pretty spectacular bank collapse a few years ago and, turn that talent into a $17 billion turbocharger for their balance sheet.
I mean, it completely flips the traditional banking model on its head.
Right.
Usually in a high interest rate environment like the one we're in right now, banks are just bleeding cash. They're just trying to keep their depositors from fleeing to higher yielding assets. But the mechanics of capturing the operating cash of the ultra wealthy, it creates an entirely different financial gravity.
Because it's essentially zero interest money. Right, just sitting in payroll and treasury account.
Exactly, it just sits there.
So that's the core of what we are doing today on this Talk Tickers deep dive. We are tearing apart the Q2 2026 earnings call for Citizens Financial Group. Ticker symbol, CFG.
A very interesting call, to say the least.
Oh, absolutely. And our goal here for you listening is to take the very dense, jargon-heavy reporting from this Wall Street call and translate the mechanics of what CFG is actually doing into plain, actionable intelligence.
Because you really have to understand the mechanics here.
You do, because if you are evaluating bank stocks right now, you cannot just look at the sector as a monolith. You just can't.
No, I mean, you have banks that are dying by 1,000 paper cuts from deposit costs, and then you have CFG.
Right, CFG, which is executing one of the most aggressive structural pivots we've seen in modern retail banking.
The term structural pivot is critical here. It really is. I mean, if you think about the typical life cycle of a regional bank, it is highly defensive.
Right, very conservative.
Yeah, you take in local deposits, you lend them out for local mortgages or, local small businesses, and you try to keep your operating expenses as low as humanly possible.
It's basically a localized utility.
Exactly. And historically, when a regional bank tries to break out of that mold, when they try to build investment banking arms or chase private wealth, they usually end up destroying shareholder value.
Because they just don't have the scale.
Right. They don't have the scale, they don't have the culture, and they end up getting completely crushed by the massive money center banks like JP Morgan or Morgan Stanley.
But CFG is posting record numbers. I mean, they aren't just dipping a toe in here. They have built a full-fledged wealth management and commercial powerhouse inside the shell of a regional bank.
It's pretty wide to see in the data.
It really is. So I want to dive straight into the headline numbers from this second quarter report, because when you look at these metrics, they simply do not look like the metrics of a standard regional bank in 2026.
They look like a totally different category.
Yeah. So for Q2, CFG reported an earnings per share, or EPS, of $1.30.
Which is huge.
Right. That is a 15% jump sequentially from the first quarter of this year, and it's up 9% year over year.
I mean, a 15% sequential jump is staggering when you consider the current macroeconomic reality.
Right. It's not like the economy is just booming for everybody.
Exactly. We aren't in a zero interest rate policy environment anymore where money is just free and loan demand is through the roof.
Right. The Fed is holding rates steady.
Yeah. Corporate borrowing is cautious. Consumer spending is being closely monitored. So for a bank with hundreds of billions in assets to juice their earnings by 15% in a single 90-day period,
it's massive.
It requires an incredible level of internal efficiency.
Which actually brings us to the efficiency metric that management, they practically shouted it from the rooftops on this call.
Oh yeah, they love this one.
ROTCE, return on tangible common equity. They bumped it up to 13.9% this quarter compared to 12.2% in the first quarter.
That's a huge leap for a single quarter.
It is. And I want to spend a minute here because, executives love throwing ROTCE around to sound smart on earnings calls, but the actual mechanism of what it measures is fundamental to understanding why CFG is so profitable right now.
It really is the ultimate litmus test for a bank's management team.
So how do you break it down for the listener?
Well, to understand it, you first just look at standard return on equity, or ROE. So if a bank has $1 billion of shareholder equity and they make $100 million in profit, the ROE is 10%.
Simple enough.
Right. But banking is an industry built on constant mergers and acquisitions.
Yeah, they're always buying each other up.
Exactly. So when CFG buys another bank, like they did with Investors Bancorp a while back, they often pay more than the literal book value of that bank's assets.
Because they're buying the brand, the customers, all that stuff.
Right. And that premium gets recorded on the balance sheet as an intangible asset called goodwill.
Right. But goodwill isn't cash you can lend out. Like, you can't issue a mortgage backed by goodwill.
No, not at all.
It's just accounting math to make the balance sheet balance after an acquisition.
Exactly. So ROTCE strips all of that invisible, intangible accounting noise out. It looks purely at the hard, tangible capital the bank actually holds.
So it's asking, what are you doing with the real money?
Right. It asks, how much actual cash profit are you generating from the hard cash your shareholders have entrusted to you?
And jumping from 12.2% to 13.9% in 3 months?
It means they are utilizing their capital significantly better. They aren't just sitting on cash. They are deploying it into higher yielding assets while strictly controlling their overhead.
And the end goal they reaffirmed is a 16% to 18% ROTCE by the end of 2027.
Which is incredibly ambitious.
Yeah, if they hit that, it puts them in the absolute upper echelon of financial institutions, period.
Oh, without a doubt.
But the metric that really jumped out to me, the one that honestly seems to defy the current laws of financial physics right now, is their net interest income. NII.
Yeah. The NII numbers were crazy.
They saw a 14% jump in net interest income year over year and a 4.4% jump sequentially.
That is just staggering.
Right.
Yeah.
Especially when you consider that the core engine of a bank, lending out money at a higher rate than you pay depositors, is currently under siege across the entire industry.
Net interest income is the lifeblood of the banking sector. And you're exactly right. The industry is facing a massive crisis of what we call deposit beta.
Right. Explain deposit beta real quick.
So when the Federal Reserve raises rates, or, keeps them elevated like they are now, it takes a little while for consumers to wake up.
They're a bit sluggish to react.
Right. But eventually people realize they are getting 0.01% in their checking account, while the government is offering 5% on treasury bills.
Yeah, nobody wants to lose out on that spread once they figure it out.
Exactly. So they move their money, they demand high-yield savings accounts, or they lock their cash into certificates of deposit. And to stop the bleeding, banks have to raise the interest rates they pay to their depositors.
And every extra dollar they pay to a depositor is a dollar subtracted directly from their net interest income?
Precisely. It absolutely crushes their net interest margin, or NNM, which is the spread between what they earn on loans and what they pay on deposits.
Which is why we're seeing so much pain in the regional banking sector.
Yeah, most regional banks right now are reporting shrinking margins and declining net interest income because their funding costs have skyrocketed.
But Citizens reported that they actually expanded their net interest margin by 10 basis points in the first half of the year.
Which shouldn't be happening normally.
Right, but hold on. Funding costs are universally brutal right now. You can't just wave a magic wand and expand your margin by 10 basis points when everyone else is bleeding cash just trying to retain deposits.
Right.
I mean, even the CFO, Anupam Banerjee, explicitly noted on the call that the rate environment remains incredibly challenging.
He did, yeah.
So what is the actual mechanism they are using to dodge that bullet? How do you grow NII by 14% when the cost of your raw materials, meaning deposits, is through the roof?
Well, you don't do it by fighting the same war as everyone else.
Okay, what do you mean by that?
The standard regional bank is locked in a knife fight over retail CD rates. They're trying to lure middle-class savers with like a 4.5% yield.
Right, you see the ads everywhere.
Exactly. But CFG realized that is a total race to the bottom. So they completely changed the battlefield. The massive expansion in their net interest income is almost entirely driven by the staggering success of their private bank.
Okay, yes. This is where the story gets really fascinating. Because the creation of this private bank is directly tied to one of the biggest financial stories of the last few years.
It really is.
I mean, if we look at the numbers, this private bank is only in its third year of existence. 3 years.
Which is practically a newborn in banking terms.
Right. But they have already amassed $17.8 billion in deposits, $9.7 billion in loans, and $11.2 billion in client wealth assets.
In just 36 months.
Yeah. In just 36 months, this single division has grown to account for 11.5% of the entire bank's pre-tax income.
And it operates with a return on equity of around 25%, which is, it's essentially printing money.
It's absurd.
It is. But to understand how they built a $17 billion behemoth from scratch so quickly, you have to look at the wreckage of the regional banking crisis of 2023.
Right. Silicon Valley Bank's signature, all of that.
Exactly. But specifically the collapse of First Republic Bank.
First Republic.
Yeah, First Republic was legendary for its private banking model, particularly in California. They banked the tech founders, the venture capitalists, the real estate moguls of Silicon Valley and San Francisco.
The ultra wealthy.
Right. And when First Republic collapsed and was sold off to JP Morgan in that sort of weekend fire sale.
I remember that. It was chaotic.
It was. And it caused a massive diaspora of elite private banking talent. These bankers were suddenly untethered. They had massive books of business clients who trusted them implicitly, but they needed a new platform.
Because they didn't necessarily want to just become another cog in the massive JP Morgan machine.
Exactly. And CFG was incredibly aggressive here. They didn't just hire a few executives. They essentially lifted out entire teams of private bankers, particularly in California, New York, and Boston.
And when you hire a top-tier private banker, you aren't just hiring an employee.
No, you are acquiring the Rolodex.
Right. The clients follow the banker because the relationship is with the individual, not the corporate logo on the door.
Exactly. It's a deeply personal relationship.
But wait, how does that actually solve the deposit cost problem? I get that rich people have a lot of money, obviously, but wealthy individuals are usually hyper aware of interest rates.
Sure.
Right. Like they have family offices and wealth managers specifically designed to maximize yield. Why would they provide CFG with cheap deposits?
Well, this is the genius of the ecosystem banking model. It operates almost like a retail loss leader.
Okay, give me an analogy.
Think of the $1.50 hot dog at Costco.
Oh, classic.
Right.
Yeah.
Costco loses money on the hot dog, but it gets you in the door to buy a $2,000 television.
Right.
In private banking, the hot dog is the obsessive white glove personal service.
The concierge treatment.
Exactly. The banker handles the client's complex personal mortgage, their yacht financing, their bespoke investment portfolio, their trust, and estate planning. They provide an incredible level of service for the individual's personal wealth.
And they probably give them great rates on those personal loans, too.
Oh, absolutely.
All right.
But in return for that incredible personal service, the client brings over their business accounts.
The business account.
Exactly. The private banker says, look, I've optimized your personal portfolio. Now let me handle the operating cash for your businesses. And this is the Holy Grail.
Okay, why is that the Holy Grail?
Let's say the client owns a chain of 50 high-end car dealerships across the West Coast.
Okay.
That business has massive daily cash flows. They have to process payroll for thousands of employees. They have millions in daily revenue sitting in clearing accounts. They have working capital parked in treasury accounts just to facilitate inventory purchases.
So that's the operating cash.
Right. And operating cash is fundamentally different from investment cash. Operating cash is not rate sensitive.
Because it's constantly moving.
Exactly. A business owner is not going to move their massive complex payroll accounts to a different bank just to chase an extra 50 basis points of yield. The friction, the operational nightmare of changing treasury management banks is enormous.
Oh, I can't even imagine the headache of rewiring payroll for thousands of people just for a tiny yield bump.
Right? They just won't do it. So that money just sits there, facilitating the day-to-day operations of the business.
Which means the bank is holding millions and millions of dollars that they are paying zero or like near zero interest on.
Exactly. The CFO laid this out explicitly. Roughly 30% of the deposits brought in by the private bank are demand deposit accounts, or DDAs.
And DDAs pay zero interest.
Zero. And over 50% is a mix of DDA and very low-cost savings. So the all-in cost of deposits for the private bank division is roughly 2.1%.
That is incredible. While other banks are paying 4.5% or 5% to attract retail CDs, CFG is funding its operations at 2.1% because they captured the operating cash of the ultra-wealthy.
Yep. And then they turn around and lend that cheap money out.
Right, to generate the return.
Exactly. Brendan Coughlin, the president of the bank, noted that their yield on the loan book within the private bank is just north of 6%.
Wow.
Yeah. So when you are funding at 2.1% and lending at 6%, you are generating a massive 4% spread.
That is a huge spread in this environment.
It is. And that nearly 4% spread acts as a high-octane fuel injection for the entire bank's balance sheet. It is the underlying mechanism that allowed them to expand their overall net interest margin by 10 basis points while the rest of the industry was suffocating.
So the traditional regional consumer bank is the base engine. It's solid, it takes in normal retail deposits, issues standard auto loans and mortgages, but the private bank is this massive turbocharger.
That's a great way to put it.
It's sucking in billions of dollars of zero interest operating cash and using it to fund highly profitable loans. But, whenever you talk about rapid loan growth, especially in a new division, the immediate question for any investor is risk.
Oh, absolutely. Credit risk is always the shadow.
Right. Like, are they taking on bad debt just to generate that 6% yield?
That's actually the most compelling part of this specific strategy. Lending to ultra-high net worth individuals and their associated businesses is historically one of the safest forms of lending in the financial sector.
Because they have so much collateral.
Exactly. These clients have massive liquid assets, highly diversified income streams, and extensive collateral. And management was very clear on the goal. In the 3-year history of the private bank, they have not had a single credit loss.
Zero.
Zero
Losses on nearly $10 billion in loans. You really cannot ask for better credit quality than that.
You can't.
But, we have to look beyond just the private bank because CFG is a massive institution and they have legacy portfolios.
They do, yeah.
And right now, the absolute boogeyman terrifying the regional banking sector is commercial real estate, specifically office buildings.
Oh, the office doom loop.
Right, the office doom loop. We all know the narrative. Remote work hollowed out the downtowns, office values are plummeting, and the regional banks holding those mortgages are going to take massive rate downs. So how is CFG navigating that?
They are navigating it through aggressive, proactive pruning.
Okay, pruning, like a garden.
Yeah, exactly like a garden. If you leave the rotting plants alone, the rot spreads. CFG has been intentionally running down their non-core and general office CRE portfolios for several quarters now.
So they're just getting rid of them.
Right. They aren't renewing loans for struggling B-tier office parks. They are letting those loans mature, taking whatever small lumps they have to, and getting that exposure off their books.
And then reallocating that capital into the private bank or into residential mortgages or middle market commercial loans?
Exactly. And the data proves the strategy is actually working. Across the entire bank, their net charge-offs, which is the percentage of loans they actually have to write off as completely uncollectible, dropped this quarter.
Dropped?
Yes. Dropped from 39 basis points to 37 basis points.
Okay, that's moving in the right direction.
And even more impressively, their non-accrual loans dropped by 4%.
And non-accruals are the loans where the borrower has missed multiple payments.
Right. It's when the bank basically stops counting the expected interest as income because they know the borrower is in trouble. But those dropped by 4%. So their overall credit profile is actually getting cleaner in a really tough economic environment.
But, we don't just have to take management's word for it, because the ultimate validation of their balance sheet came from the Federal Reserve itself just a few weeks prior to this earnings call.
Ah, yes, the stress tests.
Right. Every year, the Fed conducts its stress tests. For you listening, this is a massive, rigorous simulation where the Federal Reserve essentially models a doomsday economic scenario.
It's intense.
It is. They simulate a massive spike in unemployment, a crash in the stock market, and a severe depression in commercial real estate values. Then they look at every major bank and ask, if this happens, do you have enough capital to survive, or do you collapse?
And historically, CFG has actually struggled with this specific test.
Really?
Yeah, CEO Bruce Van Saun actually referred to their previous stress test results as a scarlet letter.
A scarlet letter, wow.
Yeah. The Fed's internal modeling consistently projected higher losses for CFG than for its peers, largely because of the specific makeup of their legacy loan book.
And when the Fed projects high losses for you, they enforce a penalty, don't they?
Right. It's called the Stress Capital Buffer, or SCB.
Yeah.
If the Fed thinks you are risky, they mandate that you hold a massive pile of cash in reserve. You can't lend it out, you can't invest it, and you certainly can't return it to shareholders as dividends.
It just sits there.
It just sits there, dragging down your efficiency and, going back to that metric we talked about, dragging down your ROTCE.
But Bruce Van Saun said they officially tore the scarlet letter off their jersey this year.
They did. In this year's test, CFG posted the third best loss rate among all their regional peers.
Third best. That's a massive turnaround.
It is. Their performance was so strong that the Federal Reserve dropped their required stress capital buffer down to 2.5%.
And 2.5% is the absolute regulatory floor, right?
Exactly. The Fed is essentially certifying that CFG's balance sheet is pristine.
Which fundamentally changes what management can do with their cash. Because if you don't have the Fed forcing you to hoard billions in reserves, you can actually deploy it.
And they absolutely are deploying it.
Yeah, they returned $920 million to shareholders through dividends and stock buybacks in just the first half of this year.
Nearly $1 billion.
Right. And when a bank is buying back its own stock aggressively, it is a massive signal of confidence from the C-suite that they believe the market is undervaluing their assets.
It's the flywheel effect in action. Think about it.
Walk me through the flywheel.
The private bank brings in cheap deposits. The clean balance sheet means they don't have to hoard capital. The cheap deposits fund high-yield loans, generating massive cash flow, which they then use to buy back stock, which increases the earnings per share for the remaining shareholders, which drives the stock price up.
It's a beautiful machine when it works.
It really is.
But there is a third pillar to this revenue engine, and it's something that traditionally regional banks are just terrible at.
Oh, you mean capital markets?
Yes, capital markets. CFG reported a massive 46% year-over-year surge in capital markets fees. Now, when most retail investors think of capital markets or investment banking, they think of Goldman Sachs or Morgan Stanley doing, billion-dollar IPOs for tech companies.
Right, the big flashy deals.
Exactly. So what exactly is a regional bank doing in the capital markets space to generate a 46% jump in fees?
Well, this is where we have to look at the mechanics of middle market corporate finance. CFG is not trying to take the next massive AI tech startup public.
They're staying in their lane.
Right. They operate in the middle market, which is generally companies valued between $50 million and $1 billion. And their capital markets revenue is driven by three main activities: loan syndications, bond underwriting, and M&A advisory.
Okay, let's break those down, starting with loan syndication, because that is a massive revenue driver that most people just don't fully understand.
Sure. So imagine a mid-sized manufacturing company that wants to buy a competitor.
Okay, got it.
They need $600 million to execute the buyout. Now, CFG might have a great relationship with that manufacturer, but they don't want to put a single $600 million loan on their own balance sheet.
Because it's too much concentrated risk for one client.
Exactly.
Right. If that one manufacturer goes bankrupt, it blows a massive hole in the bank's quarterly earnings.
So instead, CFG acts as the lead arranger.
Okay.
They tell the client, look, we will structure the $600 million loan. We will put $100 million on our own balance sheet, and we will syndicate or sell off the remaining $500 million to 5 other regional banks or institutional investors who each take a $100 million slice.
Wait, so they just slice it up and hand it out?
Basically, yeah.
And the magic is that CFG charges a massive fee for arranging the whole puzzle.
Exactly. They might take a 1% or 2% fee on the entire $600 million package just for structuring the deal and finding the other lenders.
That is pure fee income.
Pure fee income.
Yeah.
It drops straight to the bottom line, and because they only kept $100 million of the actual loan, it requires very little regulatory capital to be held in reserve.
That is so smart. And they are doing the same thing with M&A advisory, right?
Yes, exactly.
Because when a private equity firm wants to buy a middle market company, they need investment bankers to value the target, negotiate the terms, and arrange the debt. And over the past few years, CFG aggressively acquired boutique advisory firms.
Right. Firms like DH Capital, which specializes in tech and telecom, and Matrix Capital Partners.
This is the critical how of their strategy. A regional bank can't just build an M&A advisory team from scratch, right? The talent is too specialized.
It's way too specialized.
So CFG just bought the boutique firms that already had the relationships and the expertise and plugged them into the massive Citizens balance sheet.
It's brilliant. Now, when a middle market private equity firm needs to do a deal, they don't call Goldman Sachs.
Because Goldman Sachs doesn't want to get out of bed for a $200 million acquisition.
Right. The fees aren't big enough to move the needle for them. But CFG treats that $200 million deal like it's the Super Bowl.
They roll out the red carpet.
Yeah. They provide white glove advisory service, they arrange the syndication, and they capture millions in fee income.
Ted Swimmer, the head of commercial banking, explicitly noted on the call that CFG is now ranking as the #2 middle market sponsored book runner.
That is a wild stat.
#2. That means out of all the banks in the country, when private equity firms are doing middle market buyouts, CFG is the second most active bank they use to arrange the debt. That is an incredible market share capture for a bank of this size.
And again, the beauty of fee income is capital efficiency. When you earn a $10 million fee for advising on a merger, there is no credit risk.
You don't have to hold capital against a fee.
Exactly. It is highly efficient revenue that accelerates that ROTCE metric. So you have the private bank generating net interest income and the capital markets division generating non-interest income. Both engines are firing simultaneously.
So they've basically weaponized their private bank to capture cheap deposits today, and they've built an elite middle market investment bank to drive fee income.
That's the playbook.
But the obvious question is, how do they scale this without blowing up their operating costs? I mean, a bank can't just keep hiring expensive private bankers and acquiring boutique firms without expenses spiraling out of control.
Right, that's the danger.
And that brings us to management's guidance for the rest of 2026 and their highly controversial plan for their physical branches.
The guidance is incredibly bullish. For the third quarter, management expects net interest income to rise another 2.5% to 3.5%, with fee income up about 1% and expenses remaining entirely stable.
Stable expenses while revenue grows.
Right. But the metric that defines their ability to scale without blowing up costs is what they call positive operating leverage. They are projecting over 600 basis points of positive operating leverage for the full year 2026.
Okay, let's clearly define the mechanics of operating leverage, because it really is the holy grail of corporate finance.
It is. Operating leverage is basically the physics of banking scale. It simply means your revenue is growing faster than your expenses.
Simple enough.
Right. So if your revenue grows by 10%, but your operating expenses like salaries, real estate, technology only grow by 4%, you have a 6% gap. That is 600 basis points of positive operating leverage.
Which means every new dollar of revenue is dropping straight to the bottom line as pure profit, rather than being eaten up by the cost of doing business. You aren't just buying growth by spending wildly, you are scaling efficiently.
Exactly. But to maintain that operating leverage, you have to constantly optimize where you are spending your money.
You have to cut the fat to fund the muscle.
Right. And for CFG, the fat is in their retail branch network. They announced a massive strategic pivot on this call called Project NXT,
which stands for Network Evolution and Experience Transformation.
Classic corporate naming.
Gotta love it. But underneath the corporate acronym, the reality is a ruthless reallocation of real estate capital. They are shutting down 100 to 120 in-store branches.
Yeah, this is a huge move.
For context, these are the tiny branches you see inside supermarkets and grocery stores. And they are taking the cost savings from shutting those down and using it to fund brand new, standalone, high-density advisory branches.
And to understand why this is so critical, you have to look at the historical evolution of retail banking.
Okay, take us back.
20 years ago, the dominant strategy in banking was ubiquity. You wanted to put a branch on every single corner and in every single grocery store.
Right, you want it to be everywhere.
Because the goal was to capture every possible transaction.
Yeah.
Someone cashing a physical paycheck, depositing a $20 bill, or getting quarters for the laundromat. It was a volume game based on foot traffic.
But the smartphone totally destroyed that model.
Yeah.
I mean, I haven't deposited a physical check with a human teller in 5 years.
Oh, easily. Me neither.
The transactional value of a physical brand has effectively gone to zero.
Precisely. And supermarket branches are the absolute worst offenders. They attract incredibly low value, highly transactional foot traffic. You are catching people while they are irritated, rushing to buy milk and eggs. You are not sitting down with them for 45 minutes to discuss their small business loan needs or their retirement portfolio.
That's a great point.
Maintaining a physical presence in a grocery store is a massive drain on operating expenses with almost zero strategic return in 2026.
So Project NXT is a strategic retreat from transaction volume. But I have to ask, because whenever a bank announces they are closing over 100 branches, the immediate market reaction is usually fear.
People assume the worst.
Right. It sounds like a bank that is struggling, shrinking its footprint just to slash costs and make the quarterly balance sheet look pretty. Are they just shrinking the bank?
The analysts actually pushed them really hard on this during the Q&A, and Brendan Coughlin was very clear. This is not a retreat, it is a reallocation. They are currently maintaining around 1,000 total branches, and they expect the total branch count to remain relatively stable over the next 5 to 7 years. They're not shrinking the footprint. They are fundamentally upgrading the purpose of the footprint.
The physical branch is no longer a transaction center. It is an incredibly expensive billboard for financial advice.
That is the perfect way to look at it. They are closing 3 tiny, useless desks in 3 different grocery stores, and they are using that money to open one beautiful, standalone advisory hub in the commercial center of town.
Right.
And they are staffing that new hub differently, too. It's not just tellers processing deposits. They are staffing it with private client bankers, wealth advisors, and small business lending specialists.
They are turning the branch from a place where you do a chore into a place where you build a wealth strategy.
Exactly.
And the financial goal of this pivot is massive. Bruce Van Saun explicitly stated that by upgrading the branch network, they expect to boost retail deposit growth to outpace the standard GDP growth rate by 2%.
Which is a huge structural advantage.
He even did the math on the call. Over a 10-year period, adding 2% above GDP growth equates to capturing an incremental $20 billion to $30 billion in attractive, low-cost deposits.
Which loops us right back to the very beginning of our analysis today.
It really does.
The entire strategy of CFG is designed to secure low-cost, sticky deposits to fuel the lending engine.
Yeah.
You cannot capture $30 billion by cashing checks in a supermarket.
Cards can't.
You have to target the mass affluent, the local dentists, the successful plumbers, the mid-level corporate executives, people who have real wealth that needs managing. And by funding these new advisory hubs with the savings from closing the supermarket branches, the entire evolution is self-funding.
Which protects that precious operating leverage.
Yes, exactly.
And we are actually seeing this strategy play out geographically as well. They aren't just rearranging branches in their historic Northeast footprint. They are following the money.
Oh, this was a great detail from the call.
Yeah. They mentioned they already have 10 private bank offices open, which were heavily concentrated in California because of the First Republic acquisition. But they specifically highlighted their new office in West Palm Beach, Florida, and noted that they are aggressively targeting the Florida market next.
Yeah, it is a brilliant demographic play. There is a massive, well-documented migration of wealth moving from the Northeast, New York, Boston, Connecticut, down to Florida for tax purposes and lifestyle.
Everybody's moving to Miami or Palm Beach.
Right. And CFG is a dominant legacy player in the Northeast. They are simply ensuring that when their ultra-wealthy clients retire or move their business operations to Florida, the bank moves with them.
So they don't lose the client.
Exactly. If you have a business owner in Boston who relocates to Palm Beach, CFG wants to ensure they walk into a pristine advisory hub with the exact same white-glove private banking service they're used to, preventing that client from defecting to a local Florida bank.
It's all about retaining the ecosystem. Okay. We have dug deep into the mechanics of this earnings call. We've gone through the First Republic playbook, the mechanics of operating cash, the reality of the Fed's stress tests, the hidden engine of middle market capital markets, and the evolution of the physical branch network. Let's bring all of this together for the listener. We are moving into our Talk Tickers verdict.
Let's do it.
If you are a retail investor looking at CFG today, what is the actionable takeaway from this source material?
Well, if you're evaluating CFG for a portfolio, the source material heavily suggests you shouldn't be modeling them against standard regional banks anymore.
Right, throw the old comps out the window.
Yeah, the historical metrics used to value a regional bank based on, basic consumer deposit growth and local mortgage origination. They are insufficient to capture what CFG is actually building here.
Because they're a hybrid now.
Right. They are operating a highly sophisticated, high-margin wealth management and commercial banking hybrid. So based on the mechanical execution of their strategy, the immaculate credit quality, and their strict expense discipline, the underlying data presents a highly bullish setup.
I agree. I mean, this earnings call is a masterclass in management doing exactly what they told the market they were going to do.
They executed flawlessly.
They did. They promised to build a private bank out of the ashes of First Republic, and they built a $17 billion juggernaut. They promised to optimize their capital to beat the Fed's stress tests, and they dropped their buffer to the absolute regulatory minimum. They promised positive operating leverage, and they are delivering 600 basis points of it.
It's rare to see management check every single box like that.
It really is. So if you already hold this stock, the mechanics suggest this is a classic compounding story. The engine is running perfectly. There is no reason to interrupt the compounding process.
Just hold and let it compound. And if you are considering allocating new capital to the financial sector, the discrepancy between CFG's actual business model and its current market valuation is the opportunity.
Because Wall Street is slow to adapt.
Exactly. The market is still pricing CFG, largely like a traditional Northeast regional bank facing deposit headwinds. The market hasn't fully digested the fact that the private bank turbocharger has structurally changed their net interest margin trajectory. They are finding cheap money where no one else is looking, and they are lending it out at highly profitable spreads without taking on dangerous credit risk.
Which leaves us with one final, very provocative thought for you to mull over. We've talked extensively about how well CFG is performing right now, but we have to remember the context. During the Q&A portion of the call, Ted Swimmer noted that their record-breaking capital markets quarter, that massive 46% surge in fees, was driven almost entirely by companies refinancing existing debt.
Right.
It was not driven by a massive M&A boom. He explicitly said they still haven't seen a perfect deal market.
That is arguably the most tantalizing detail in the entire transcript.
Why is that?
Because right now, across the private equity landscape, firms are sitting on absolute record amounts of dry powder.
Meaning uninvested cash.
Right. Billions and billions of dollars in raised capital that is just sitting in accounts, waiting to be deployed to buy companies. But private equity has been sitting on their hands because of macroeconomic uncertainty, volatile interest rates, and geopolitical tensions. The M&A market has been relatively frozen.
Exactly. So here's the question you need to ask yourself as an investor. CFG is currently posting 15% sequential EPS jumps. They are expanding their margins, they are hitting all-time record capital market fees, and they are doing all of this in a macroeconomic environment that is, at best, merely okay.
The M&A market is practically asleep.
Right. So if this is what their financial engine produces when the middle market economy is just idling in traffic, what happens to their fee revenue when the traffic clears?
It's a great question.
What happens when the Fed finally signals a definitive long-term rate path, geopolitical tensions ease, and private equity decides it is time to deploy that $1 trillion of dry powder?
The floodgates of middle market mergers and acquisitions will burst open.
And CFG is already the number 2 book runner in that space. The turbocharger is fully spooled up, the mechanics are flawless, and they are just waiting for a clear stretch of highway. Thanks for joining us on this Talk Tickers Newt Dive. We'll see you next time.